Welcome back. We have our second element now in the unit on tax transparency. We're talking about incentives, right? Again. So when it comes to disclosure, regardless of what to disclose, you always have to question the incentives of the sender. As there's only rarely a case where you can assume that the regulation is so tight that incentives don't matter, so that there is no degrees of freedom for the sender. And this is also true when it comes to tax transparency. And I think it's really challenging in this field because let's say the incentives of the stakeholder of this information exchange actually vary so dramatically, and they're also hard to grab economically at times. Okay, let's start with the tax authorities. So this is relatively straightforward. So tax authorities have an incentive to receive these tax disclosures because it helps them to do their job better, right? So if tax authorities are concerned that there are loopholes in the tax regulation that allows, in particular, multinational corporations to shift, let's say, taxable income around or to jurisdictions that have lower tax rates, then of course there is a demand from these tax authorities to actually obtain information that allows them to assess the magnitude of the problem and maybe to address it via regulation or supranational contracting, so that in the end this problem becomes less severe. So there is an interesting political economy question luring here. So how can actually tax authorities, multinational tax authorities, coordinate on something like this? This is really interesting, but beyond the scope of the, let's say, the whole tax transparency literature. But in principle, understanding how tax authorities actually can reach a common objective in that regard is highly interesting. So think about also the minimum taxation for corporation discussions that we currently have internationally. Really, really interesting area. Okay, so but in principle, the incentive for for the tax authorities is relatively clear. Okay, so for investors, it is also not that complicated if you assume that investors, so our prototypical investors, are solely interested in maximizing their risk-adjusted rate of return. So if this is what they want, then they are clearly interested in having informative disclosures that allow them to assess the distribution and timing of future cash flows. And here, of course, tax information might come in handy for valuation purposes. It might also be interesting from a contracting perspective, because if you are as an investor, you want to monitor your manager, and you want to make sure that the manager chooses a value maximizing tax planning strategy, then you need information to actually assess the, let's say, the output of the manager in that regard. So here, in principle, our prototypical investor will be interested in this kind of information. The idea will be that there is some level of efficient tax planning that maximizes firm value. So that does not necessarily mean that these rational, super rational investors will be all in favor of a fully aggressive tax strategy, because it might well be the case that this fully aggressive tax strategy might be too costly, either by a direct implementation costs, or, for example, because there would be some offset from other stakeholders of the firm that basically in the end reduce firm value again. So in principle, this does not mean that investors would always prefer very tax aggressive firms. It's just a statement that investors could value the information on tax planning and tax avoidance in front of this background. Okay, so now to the non-financial stakeholders. So think about employees, think about maybe also customers and suppliers, or the interested public. Okay, so these non-financial stakeholders, for them, so at first glance, you'd say maybe they shouldn't care too much about the tax planning of a corporation, right? It's not really their cup of tea. But as you've seen from recent debates in the media, you see that there is quite an interest in the level of taxes that corporations pay, and there is this general notion that corporations don't, especially multinational corporations, don't pay their fair amount of taxes, and there are NGOs, like for example the Tax Justice Network, that actually actively lobby for more transparency in that regard. So, and if you want to understand the incentive of these non-financial stakeholders, then I think here the legitimacy theory for management actually has a good point to make, to say that there is sort of an implicit social contract in society that everybody has to pay his or her fair share of taxes so that the overall society can be upheld and developed. And that a corporation choosing a very aggressive tax strategy might be considered to violate this social contract, and this then would threat the legitimacy of the corporation and taken to the extreme, also its right to exist. Okay, you can also, if you don't like the legitimacy theory because it's too management for you, so you can also try to express pretty much the same thought in more economic terms. So you can think about societal contracts as just a standard type of incomplete contracts in a hard way, right? And then you can assess, let's say, tax aggressiveness as essentially destroying the reputation of a firm for honoring these incomplete societal contracts. Okay, so this is essentially the same argument, just using incomplete contract theory. So in the end, it's all about the firm has a reputation that it is a good partner in crime when it comes to the things that a society needs to facilitate. And once the firm actively communicates that they don't try to aggressively avoid paying taxes, then there is this threat that they are no longer considered to be a valuable partner in exchange. Okay, which would be disastrous for a firm. Okay, so now you see these different incentives, and you clearly see that from a managerial perspective, it's now not that easy to decide how these incentives should affect the incentives of the manager per se, and then the overall disclosure choice, right? So if you take this to this level, then I think it's also important to separate between private and public disclosure. And the first idea here is to think about private disclosure towards tax authorities. Here, there's very little is known about the wiggle room in these type of disclosures, so it's not entirely clear. It's also part of a, let's say, ongoing lobbying exchange kind of process. So the firms try to avoid the tax authorities that, they don't need to provide all that information. The tax authorities demand the information, and then there's sort of a bargaining game going on. And then at some point, a regulation is being decided upon, and then this regulation is being enforced. And so it's a little bit unclear how large the degrees of freedom actually are, but they won't be that super large. So meaning that when it comes to the private disclosure, once the rules are being set, it's more or less a compliance exercise. So the firms have to comply. So it's not that much a strategy question of incentives. It is very much a question of incentives, though, to ask the question, well, how do firms lobby for certain private disclosure rules and regulations? This is really, really interesting, because this also entails, for example, the ideas of competition. For example, if you are a firm that is located in a high tax regime and for maybe exogenous reasons, and you don't want to change location, so then of course, if your competitors are located in, let's say, low tax regimes, then you have a little bit of a competitive advantage, and then you will actively lobby for maybe tighter private disclosure rules, with the idea that this will, in the end, maybe improve your competitive situation against the firms in low tax environments. So interesting from a political economy perspective. Yes, I said so, right? So now turning to the public disclosure bit. Yeah, so this is more in the center of what we can study, right? So now here, balancing these interests is tricky, right? So you have different stakeholders, and these stakeholders have relatively different interests. So, for example, your investor base maybe would be interested in understanding how smart you are in reducing your tax burden, right? Because this basically increases the cash flow to the firm and to equity in particular. So that means that maybe for them, you would actually be relatively transparent about all the smart moves you do, right? But then again, you know that there is this gray area between, let's say, tax avoidance and tax evasion, between legal and illegal things to do. And of course, once you start to become very transparent about what you do, there's always this risk that you have crossed the line without you knowing, right? And if this is being observed by the public, then you all of a sudden face legal consequences. And these legal consequences, and I think this is very important to understand here, are not only refined to the firm, but also can and probably will matter to you as an individual. Yeah, so talking about criminal offenses here. So meaning that this is a real threat to the individual that actually decides on the disclosures, right? So and you can think about this as being something that has a stochastic component. So if you think about tax complexity, and if you're in an environment which is relatively complex in terms of taxes, then you can never be entirely sure when you talk about your tax strategy whether it is still legal or not, right? So the more complex the whole regime gets, the less secure you can be, and the more reluctant you will be on average, right, to openly disclose information on what you do in terms of taxes, right? So now the next thing, and this is something, an area I feel very excited, I feel it's very exciting, and this is also, I will talk about this a little bit more on the last slide, which is coming up. So that's the question about, how competent are my stakeholders actually to understand my tax strategy? So here I coined this as tax literacy. It's a little bit, like the idea of financial literacy. How literate in terms of tax and tax rules and tax regulations can we expect our stakeholders to be? Yeah, can we trust that they really understand what we're doing here? So is there a risk that they will misunderstand our disclosures? So let's assume that you are really concerned about this legitimacy argument, right? And you really want to signal to the market that you are a good citizen. You're a good corporate citizen in a way that the corporation that you run really tries to do the right thing in terms of paying taxes. At the same time, of course, you also have to monitor competition a little bit. So you can't just give all your money to the government and say, okay, take it, right? So you have to think about what is the fair share. And so you thought really hard about it, and you have a good strategy, and you think it's a fair strategy. And now, of course, in principle, you would like to signal this to the market, right? So you would like to signal to the market, hey, look at us, we are good guys, right? So now the problem is, can you? Yeah, so given that the level of complexity in the taxation system is relatively high, can you really trust that the market, or let's say the public, will understand your tax strategy for what it is? Not easy, right? So there's always the likelihood that somebody maybe misunderstands your argument, and there's even the argument that maybe somebody might be using this information strategically to reach a private objective. For example, you have an NGO that is critical against you for reasons that are completely unrelated to taxation. Maybe the NGO can use their reputation and their market power to use your tax information in a biased way in order to present you in a bad light, and then use this in order to lobby against you, right? So our poor managers have to balance all these incentives. And I think one thing that is really interesting here is that these incentives can be very important for the firm, but also very important for the management directly. So personally, my gut feeling is that these individual risks that managers face when they provide false or fraudulent information in the area of tax reporting, so that these personal risks that they face will be relatively influential in their decision making. Yeah, so meaning that they would be extremely reluctant, for example, to just voluntarily disclose something that maybe can portray them in a bad light. So I really think that this is an area where even large institutions will lawyer up relatively extensively in order to make sure that they don't accidentally trip some line and end up in court. Okay, so this is why I think compliance and legalistic aspects will play a huge role in this decision of how to disclose. And so one thing that I would like to close this element on is a little bit more in-depth discussion of this question. Well, what do we actually assume our subjects or deciding subjects actually know about taxes? Because currently all this argument here was very much building on the assumption that the management actually knows what it is doing in terms of taxes. And there is some evidence that this might not be entirely true, right? So taxes, again, are complex. And if you think about multinational group structures and taxation, this doesn't become easier, right? So it's still complex. So now I think a fair question to ask is whether our, let's see, C-suite management people are actually capable of making tax relevant decisions, or whether they, to a large extent, outsource these decisions, maybe to their advisors, right? So tax advisor, tax preparers, you know, these kind of institutional experts that maybe understand the whole framework better than, let's say, the CEO or the CFO. Yeah, this is one aspect where these behavioral aspects become important. So maybe our decision makers only, you know, have only bounded rationality. And the next thing, and this is what I also what I already indicated on the last slide, is whenever they think about the stakeholder response, they should factor in that the stakeholders also have bounded rationality when it comes to taxes. And here I think the recent review paper by Blaufuß and co-authors is really interesting to take a look at, because they review the literature on behavioral perception biases when it comes to taxes, so individual taxes, corporate taxes, your own individual tax, the individual tax of others. You know, there's a long-standing literature in public finance and also in accounting indicating that people don't get it right when it comes to taxes, right? So they misperceive their own tax burden, they misperceive the tax burden of others, and now there's relatively little work being done on corporates or corporate citizens in that regard. Much more work is being done at the individual level because, you know, we're easier to track down. But I think it's really important that when you want to study this field to be very realistic in terms of your assumptions about what these people actually know and what they can comment on. And this, in combination with this legal liability threat, I think is something that is really driving a lot of the, let's say, reluctantness of corporate managers to be very transparent when it comes to their tax regime. Okay, so interesting. Take a look into this if you want to understand more. You see here that all these different players are analyzed here, and this is here from the perspective of a tax decision maker. Yeah, but you can also factor this into the framework of somebody who actually uses the information and maybe draws biased inferences from the information because of the rationality limitations that they face. Okay, perfect. So now the next video and the final video of this unit will be talking about the effects of tax transparency. So now that we talked about the incentives, we can talk about effects. This will be a relatively short video, not because there's not so much going on, but because you know, obviously Martin will also talk about it in the Q&A, and it is an area that is still very much emerging in the literature. Okay. Thanks, and see you in a bit.